Good morning, everyone. Welcome to our Solo 401k and Self-Directed IRA live Q&A session. Just want to make sure that you all can see and hear me okay. Some of you can respond with a quick thumbs up. I'd really appreciate that. And just want to also mention that if there are questions during the session, please feel free to type them up in our chat. You can also start doing that right now if you'd like to. We will answer them after our pre-submitted questions. Just want to quickly introduce myself. My name is Natalie with Sense Financial, and we are a boutique financial firm specializing in self-directed retirement accounts with checkbook control. I'm here with Dmitriy today. He'll be answering all of the questions. Also want to quickly introduce him. Dmitriy is the founder and president of Sense Financial Services LLC, and he began his career in financial planning and real estate investing in 2000. He owns multiple investment properties in various states and is a licensed California real estate broker. He holds a designation of Certified IRA Services Professional from the American Bankers Association, and over the years, he's taught hundreds of investment and financial planning seminars and has mentored thousands of investors. Thank you for joining us today, Dmitriy, and for answering questions.
It's great to be here with you, and looking forward to diving in. Thank you, everyone, for joining.
We'll go ahead and start answering the questions. First one here is from Rich. Can you explain the contribution schedule and amount for my Solo 401k for 2025?
Sure, Rich. The contribution slightly increased for 2025. There are, remember, with the Solo 401k, there are two contribution components. You can contribute as an employee of your own business and then as a business owner. So the employee part or employee component is called elective deferrals. And you can contribute up to $23,500 as elective deferrals. And then the profit sharing contribution, this is what the business contributes on your behalf or for you, that is up to 25% of your net compensation. The combined limit for this year is $70,000. And then if you're over age 50, you can contribute additional $7,500 as a catch-up contributions. And also in addition to your elective deferral contributions. The elective deferral contributions can be done pre-tax, or it can be done as Roth. And so is the catch-up contribution as well. Now, if you are between ages 60 and 63, you can actually, your catch-up contribution is even higher. It's $11,250. So Solo 401k is very powerful vehicle, can be used as a great tax sheltering tool to help you minimize your tax liability. So be sure to maximize those. Also, as a reminder, on our website, we do have the contribution limit section where you can go and you can see the breakdown. And we also have a contributions calculator that you can go plug in your numbers and just get the results for you. So it's pretty straightforward. And also contributions can be made in the beginning of the year, throughout the year, or at the end of the year. Most of our clients are small business owners. They choose not to contribute on a regular basis. They typically contribute once or twice per year. You can do the same thing. If you wanted to kind of front load your contributions in the beginning of the year, you can do so. You can put the maximum again if you do have the income. If you own S Corp or own LLC, that is taxed as an S Corp or C Corp, and you take in salary from your corporation, even corporation might not have the income, but if you have the money in the corporation, you can pay yourself one large paycheck and potentially front load the contributions. in the beginning of the year, then you can invest that capital and it will be working for you all year, an extra year, rather than waiting towards the end. Just a strategy here for you.
Next question we have is from Billy. Do you need additional plan documents to open a designated Roth account inside of an existing Solo 401k?
So each Solo 401k plan that we establish comes with the Roth provision. The Roth provision allows you to take pre-tax funds that are in your Solo 401k, convert them to Roth. It will allow you to accept rollovers from the Roth 401k or any other employer-sponsored retirement plan. It does not accept Roth IRA rollovers, though, at this time. There is a potential that it can change in the future, but as of right now, there is no option of bringing Roth IRA funds into Roth Solo 401k. And of course, you can make Roth contributions. So again, this provision is built in every plan, and you do not need any additional documentation to open and contribute to your Roth 401k account. If you have a Solo 401k with Sense Financial, that is already built in, and you can find that in your plan documents.
Question here from Frank. How long do I need to wait to build my Roth IRA contribution?
Frank, question a little bit unclear. You don't build your Roth IRA contributions, you just contribute. And I'm not sure what you're saying as far as waiting. There is no waiting period. If you have Roth IRA, you can contribute to it if you're eligible. Remember, contributions to Roth IRA, they're based on the income. So, and some people based on their income might not be eligible to make Roth IRA contributions. If your adjusted gross income is over a certain threshold, you might not be eligible to make those contributions. But there is always backdoor option to contribute to Roth IRA, where you can make either if your income is over a certain threshold, you might not be able to make deductible contributions to a traditional IRA. However, you can make non-deductible contributions and then immediately convert them to a Roth IRA. But there is no requirement for you to wait. You can make those contributions immediately.
Next question here is from Drew. Employer/employee contributions split. And why do we need to keep a separate accounting of the two?
A good question, Drew. I believe I just broke that down in the first question. Again, you can navigate to our website. You can use the contributions calculator, and we also have several articles related to the contributions in the client portal and the knowledge base. So go there and read up. That is very good information there. As far as the requirement to separate, that is what the IRS required. And depending on future actions, there might be a different treatment of those. Now, once you reach 60, and then those contributions will be treated the same. It's all pre-tax. But then, again, depending on certain actions, there might be different treatment. That's why IRS requires that you keep those accounting for those contributions separate.
Next question we have is from Glenn. Can I convert traditional Roth IRA to a self-directed 401k account? What are my options here?
At this time, IRS does not allow you to roll over a Roth IRA into Roth 401k. So that is not an option. You can't roll that over. You can't move those Roth IRA funds into 401k. So your only option, if you wish to self-direct that Roth IRA of yours, then the only option is to establish a self-directed Roth IRA and transfer that existing Roth IRA into self-directed and control it from there. But again, there is no option at this time to move those Roth IRA funds into a solo 401k.
Next question is from Julia. It will be my first time filing Form 5500 EZ with the self-administered plan. I would like to clarify the process.
Julia, we recently sent an email to all of our clients with the instructions on how to complete the form. It's actually pretty straightforward. If for some reason you missed that email, you can navigate to the client portal, go to the maintenance tab, and then click on the 5500 form filing instructions, where we break it down to you by each field, starting from the very beginning all the way to the end. We tell you exactly how to complete each field. The only fields that we don't tell you how to complete or what to put in them, rather, is the numbers, right? The contributions and the plan assets. So that's something that you as the plan administrator are tracking, and you will fill that accordingly. But all the other fields, we tell you exactly how to complete. So again, it's pretty straightforward. If this is a first time, then it might take a little bit longer for you to complete the form first time, because you got to look at your plan documents to pull that data and fill it into the 5500 EZ form. But once you get it done the first time, next year it's going to be pretty much the same information. You can just copy and paste for the next year. So it's pretty easy to do. Again, the only difference will be the plan assets and any contributions, perhaps loan. That might change again if you have outstanding loan. But do refer to our instructions for completing Form 5500 EZ on the client portal. We spell that out for you. Also, we do have the service that we offer for those of our clients that don't want to deal with this. We can file it for you for a fee. Just reach out to our office and we can send you the intake form, and we can get that submitted for you electronically. So you, if you're completing it yourself, you have a couple options. You can complete the PDF form, print that out, sign it, and then mail it to the IRS, or you can do it electronically, submit that report electronically. If you wish to engage us in doing that for you, we do it electronically. We submit that form electronically, which is faster. They get the record immediately, and you have the tracking for that.
Okay, next question here is from Ned. Can I transfer my existing Schwab IRA brokerage account to my 401k?
You have a traditional IRA, regardless what it is. It can be with Schwab, can be with any other custodian. If it's a traditional IRA, then absolutely, you can move that to a solo 401k. In fact, you can move almost any other retirement accounts, any other retirement plans into your solo 401k with one exception, and that exception is a Roth IRA. The process is pretty straightforward. You go to the client portal again, you go to the setup section, and then you click on the rollover. And in that section, we do provide you with the detailed instructions on how to do this, depending where you're moving the funds from. If in your case, if it is from an IRA, then you will complete the rollover form that we provide on the client portal. We also give you detailed instructions how to complete that. So you fill that up and then you mail that or perhaps submit that by fax or upload it to your custodian on their website. Check with them for the instructions. If you're doing a rollover from another qualified retirement plan, perhaps you have 401k from the past employer, then what you can do is you need to contact them, because each employer-sponsored plan, they have their own process to request that rollover. So they most likely will have their own form for you to complete. So you won't be using our form, you'll be using their form, but the concept is the same. It has to be done as a direct rollover, meaning you're not taking a distribution. The funds are not coming to you personally. The check is not issued to you, because if that is the case, then that will be tax event. And even though you can technically use the 60-day rollover rule and not ultimately be taxed for that transaction, but then you're going to have to prove to the IRS that you did, in fact, move those funds into the qualified retirement plan, and that can be a hassle, and IRS can be after you for those taxes. You're going to have to prove to them. So we never recommend this option. Always do it as a direct rollover. This way, it's very clear. It's coded properly when you receive a 1099 from the sending custodian. It will have the proper code showing that this is a direct rollover, and you'll have taxable income as zero. So do that. Again, if you need any assistance completing the form, or perhaps we actually recommend our clients, before you submit that to the custodian, to the sending custodian, let's look at it so we can just take a quick look. It's always good to have a second set of eyes reviewing things for you, and we'll catch any errors perhaps, or that needs to be corrected, and you'll correct it from the first time.
Next question that we have here is from Gavin. I have set up a solo 401k for my 1099 income. I would like to know how much I can contribute as an employer of the solo 401k plan.
I believe, again, we covered that in the previous answer, but with the solo 401k, again, there are two components. If you are 1099 independent contractor, then you will be filing Schedule C, so you're sole proprietor, and the contributions will be based on your net self-employment income. So it's not based on the gross, right? Based on the net. So you have to basically do your taxes, figure out what your net income is, which is gross income minus all the expenses, and then you have to subtract half of the self-employment taxes, and that will be the magic number that you're going to use to calculate. Again, if you use a contributions calculator, you can still go back to the calculator for 2024. You can put that number, and then the calculator will run the numbers for you and will tell you how much you can contribute. But the employee portion, otherwise known as elective deferrals, for 2024 will be $23,000, and for sole proprietor, the employer or profit sharing contribution is 20% of your net self-employment income. Numbers pretty straightforward. You just have to get the accurate numbers up front, because that's going to dictate the outcome. So get those numbers, get with your CPA, get the correct bottom line numbers, and then it's going to be very easy for you to calculate what the contributions are. And before we move to the next question, just a comment here that I'm reading your questions, or Natalie and I are reading your questions, and perhaps sometimes they're unclear. Maybe we don't fully understand the question. Again, I'm trying my best to answer the questions, but if you wish to provide clarification in that Q&A, section, do so. We want to make sure we understand your questions. So perhaps there's any follow-up questions, do that. And again, as a reminder, every time you ask the question, you're not the only one benefiting. So everybody else who listening here on the call or who will be watching the recording, they will be benefiting from your questions. So if you got something on your mind, don't postpone it, just ask away, and I'll be more than happy to address that. And we will get to the Q&A once we're done with the pre-submitted questions.
Okay, our next question is from Scott. I want to roll over my SD IRA over to a solo 401k. I have questions about the process, FinCEN, and BOIR.
Good question, Scott. If you have a self-directed IRA in place, again, if it is a traditional IRA, you can move that to solo 401k if you're eligible for solo 401k. Just as a reminder that not everyone is eligible for solo 401k. It's not for everyone. While anybody can have an IRA, to do a solo 401k, you must be eligible, and the eligibility requirements are as follows. Number one, you have to have legitimate business or self-employment activity that generates earned income or have the potential of generating earned income, or you have intentions of generating earned income. You don't necessarily need to have that income to begin with. To establish the plan, you need to have that business activity or business in place. But if you went in business for yourself, you started the business today, technically, if it is legitimate business, you can establish solo 401k for today. You might not have income today. You might not have income for the next few months, perhaps, but you are eligible to establish solo 401k. So you won't be able to make any contributions because there is no profit yet. But you can take existing retirement accounts and you can move them over into the solo 401k. So that might be the case for you. The process, again, there is a 4-step process as far as moving from the IRA to 401k. You will be working with one of our account managers throughout the entire process, and we will guide you and hold your hand throughout that process. So you'll have access to the client portal where all the steps are outlined. As far as the FinCEN and BOIR, which, let me remind you that that stands for Beneficial Owner Information Report. And this is a fairly new law that's went into effect about a year ago, a little over than a year ago. But then there's been kind of a legal battle over that, and it's been put on hold, and then it's been reversed, and then it's been put on hold again. Now it's been reversed again. So it is a law, and that applies to any LLC or a corporation that is registered with the state, and that is the law requires that each entity report who's the beneficial owner, who's behind that. It's been in place or been put in place to combat money laundering, and it's nothing to be afraid of. There is really nothing negative about this report. It's not like the government doesn't have your information. They already have your information. So don't be hesitant about filing this report. It is, again, required if you own LLC or corporation, own or control, because you might not be the owner of the LLC. An example is if you have a checkbook IRA where you have a special purpose LLC that your IRA owns, you don't own that LLC. You control it as a manager. So, and you will be the beneficial owner of that LLC. Then you must submit that report. The penalties are very severe for not filing that. So don't play with this. If you fall under that criteria, be sure to submit that. We also offer a service. We can do it on behalf of yourself. So reach out to our office. We can help you with this. But the bottom line is that must be submitted.
Okay, next question here is from Victor. Do you prepare self-directed HSA with checkbook control?
Well, we don't prepare self-directed retirement accounts, right? We set up self-directed retirement accounts. As far as the HSA is a health savings account. And before I even get to the answer, I just want to comment for those of you that maybe don't know, HSA is one of the most awesome things out there. It's actually better than a Roth IRA. It's great. So it stands for health savings account. You have to have a high deductible medical plan in place, or medical insurance in place. And if you are, then you can contribute. I think for this year, the individual limit is slightly over $4,000. A family limit is over $8,000. The contributions that you make to HSA are tax deductible. So you get to deduct those contributions from your taxes. And then the distributions, qualified distributions from HSA are tax-free. Now, if you compare that with Roth IRA, contributions are not tax deductible. You're making post-tax contributions. They are growing, tax deferred, and then eventually you can make them tax-free. But with HSA, you're taking you're making contributions are tax deductible. They are growing tax deferred, and then qualified distributions will be tax-free. Now, one thing that I think a lot of people miss is that they use their HSAs now, right? They made the contribution, they got the deduction, and then they have medical expense, and they pretty much empty out their HSA. That will be very unwise to do. That will be to your disadvantage to do, actually. The correct way of using HSA is that you contribute to get the deduction, and then you invest all the expenses that you incur for medical expenses. You collect those, you store them, you create a spreadsheet or something where you get the records. Now think about this. If you started contributing to an HSA, let's say at age 40, and you do that until age 65, that's 25 years that you can make contributions. Again, if you're putting as an individual and the family between $48,000 a year, and then it's growing tax deferred, you can end up with $1 million in 25 years. And then you can take all of that tax-free as long as you have the medical expenses to justify that. And as you get older, you will have more medical expenses. So I think for most of us, we're not going to have issue to justify the contributions. And then all the medical expenses that you incurred now in the growing phase, you just accumulate them. And you can take the distribution at age 65, as an example, for expense that you incurred when you were 40. You can go back 20 years or more. And as long as you have the receipt for that expense that you incurred, you can use that to justify the distributions, and it will be tax-free. So again, maximize it, don't take the distributions now, invest it as much as you can, and then take the distributions later. Now, to your question, we do not offer HSAs at this time. Our custodian Solera, they actually in the works offering that. So perhaps in the very near future, we will be able to offer that, but not at this time.
Okay, question here from David. Can I still make contributions for 2024?
It will be helpful, David, if you clarified which contributions are you referring to. But let me give you a few answers. You can still make a contribution to an IRA for 2024. The contribution deadline will be tax filing date, April 15. So as long as you haven't filed your taxes, you can still make a contribution for 2024. If you're talking about 401k, generally speaking, you can, but you need to qualify that. There are two components again in contributing to a 401k, elective deferrals and profit sharing. The elective deferrals, the deadline depends on the type of business that sponsors the 401k plan. So if you are sole proprietor, you do have until tax filing deadline plus extension potentially. So you potentially have until October 15th to make contributions to a solo 401k. Now, if your business is an S Corp or C Corp or LLC taxed as an S Corp, then the elective deferral contributions must be done through the payroll, and the payroll is done before the end of the year. So in that instance, then you have to do it before the end of the year. The profit sharing contributions, however, based on the business tax filing deadline. So again, corporation, the filing deadline for corporations is March 15th. And if you file for an extension, that is September 15th. So you potentially can contribute a profit sharing contribution to your solo 401k up until then, September. Again, you have to file for an extension to do so. The bottom line, contributions must be done before you file your taxes.
Okay, this question's from Matt. If a car loan from my solo 401k that I'm creating is at the main residential address, can it be a loan for up to 15 years?
A solo 401k plan gives you an option to take a loan from it. You, as a participant, can take a participant loan. You can take a car loan from a 401k. There's only two types of loans that you can take. There is a general purpose loan, which can be used for anything. If you want to use that money to buy the car, you can, but it's not a car loan. It's a participant loan. You personally take a loan from a 401k. The participant loan is a 5-year loan. Has to be repaid over a period of 5 years using amortized payments. And you can select a repayment schedule being monthly or quarterly. Again, there's no such thing as a car loan. It's a personal loan unless it is used to buy primary residence. So if you're taking a loan from your solo 401k to buy a residence, then it will be considered a residential loan. Okay, and in which case then you can extend the repayment to 15 years. Again, it has to be amortized. Interest rate is set at the time when the loan is taken, and the interest rate is set at prime plus 1%. We do have detailed guidance on how to take the loan, including the loan application, amortization schedule, and all the other instructions on the client portal. Again, use the client portal to get that information. And if you need help, feel free to reach out to our office and we can guide you on this further.
Okay, a question from Kyle. I'm thinking about changing plan sponsors. What would the process of switching to Sense Financial look like?
Kyle, this is a common practice. We have helped a number of clients switch from other providers, other plan sponsors, or document sponsors, or other. It's you're not changing. To be technically correct, you're not changing the plan sponsor. The plan sponsor is your business. That remains the same. So I believe you're referring to changing the document sponsor. So if you're using some other company who established your solo 401k, and what we found in almost all instances why people are switching is because they're not getting the service from that document provider. So they set up the plan, and then they're pretty much nowhere to be found. They charging them fees, annual fees, but they don't provide any service to them. They don't. They're not available to answer questions or provide the support. I think that's the main difference between us and our competitors, is that our approach is quite different. We're not focusing on just acquiring new clients. We're focusing on serving our existing clients. We want to retain you as a client for life, okay? And we built our system to around that. So I think that's why people come to us, because they don't want to be on left just by themselves. But if you wish to make that switch, you contact our office, you talk to one of our experts who will onboard you, and then you complete the application. We will need to get a copy of your plan adoption agreement, because we got to put some information from there. And then our team will establish the plan documents for you. The plan, you're not going to be getting a brand new plan, because technically you are not setting up a brand new plan. We're going to amend and restate your plan documents. You're going to get a brand new set of plan documents, but it's not going to be a brand new plan from the IRS standpoint. But process is pretty straightforward. Again, reach out, talk to one of our experts. They will help you through the process.
Okay, a question here from Cody. How should I be signing for my IRA LLC when making an offer to purchase real estate?
Good question. If you have an IRA LLC, then you will be making all of the investments in the name of the LLC. So LLC will be the buyer. You're the manager of the LLC, so you will be completing the purchase agreement, and you will put the LLC that your IRA owns as the buyer. So the name of the LLC must be listed, and then you will be signing. You will be signed as a manager. You can just write your own signature, and then below you put your name, and then comma manager. So that's how you will be signing, but the titling of all the assets will be in the name of the LLC.
All right, moving on to questions that were submitted here in our Q&A section. A follow-up question from Julia regarding Form 5500 EZ. Which supporting forms are needed, if any? All of my investments are into syndications. Do I ask the sponsors for FMV form, add up the values, and put them on 5500 EZ form? Which forms do I need from the sponsors?
I believe, Julia, you're referring to the total plan asset question. I believe that's section 7 in the Form 5500 EZ, where you are required to report the total plan assets. And how you get the total plan assets is by taking everything that is in your solo 401k. Now, let me emphasize that you might have 2 participants, which is half the time the case. Half the time we just have one solo participant in a solo 401k plan, but in other cases we might have 2 participants, a husband and wife. So they own a business together. There are 2 participants, but remember, it is a single plan. So you have to include plan assets, total plan assets, and that certain plan assets might be owned by one spouse's 401k account. The other assets might be owned by the other spouses. You have to calculate the total. To calculate the total, you take all the assets, you add them all up, and then you also add any cash that you might have in your 401k bank account, a brokerage account perhaps, and then you come up with the total. Now, You need to know the value as of end of the year. We can't help you come up with the value, so that's something that you will need to figure out how to do. If it is in syndications, you typically will get a K1 from that syndication. So each syndication sends out the K1, and the K1 should have that value. So you don't necessarily need to contact them and get that value specifically. It will be given to you on the K1, and sometimes K1 they're delayed. I've experienced that in some cases. I think I got a K1 well into summer. I think, but that's typically on the funds that invest in multiple deals. But regardless, when you get a K1, there will be the valuation there. Otherwise, yes, you may need to contact the investment sponsor and get the value of your share, of your investment share. There are now remember, this is for informational purposes only. So when you report in on the form 5500DZ, this is you just informing the IRS. So it doesn't have to be super accurate. For example, if you own a rental property in your 401k, you can just go on Zillow and you can pull the value from Zillow and use that amount. Now, if, for example, you are doing a ROT conversion, you take the property that is owned by your pre-tax 401k, and then you wish to convert it to ROT, well, then you need the third-party valuation, you need the accurate numbers. Or if you take in a distribution as a property, you may not know this, but you should know that you can actually take the asset out of your 401k as a distribution in kind. You don't have to pull just the cash out. Yes, you can sell the property and just take the cash out, but you can actually take the property out. Well, in this case, whether it's the in-kind distribution or you're doing a ROT conversion, it's a taxable event, you do need accurate numbers there, then you have to get an appraisal and pay for an appraisal and get that exact value. But 500, that is not required. You just need the approximate value. However, you wish to get that, but you need some kind of supporting document to justify that.
Okay, a question here from Ned. Assuming I am contributing within the limits you mentioned, can I contribute all of my income? Is there a limit of what percentage of your income you can contribute?
Yes, as I mentioned, Ned, it is based on the type of business that you have and the type of contribution that you're making. So again, I will recommend that you go to the client, you go to our website and then go under Solo 401k section and then click on contributions calculator and run the numbers. But let me give you an example. Let's just run the numbers here really quick. I'm just going to use rough numbers. Let's say you're a sole proprietor. And as a sole proprietor, your net income, which is income, gross income minus all the expenses, let's say it's $50,000. And you're under 50. Well, as the elective deferrals, you can contribute $23,500 for this year. And then it will be approximately 20% of that $50,000 as profit sharing. It's actually going to be a little bit less because you have to subtract half of the self-employment taxes. So you will need to, again, if you use the contributions calculator, it will run those numbers for you. But it's not going to be 100%. It's going to be less than 100%. Okay, so hopefully that helps.
Okay, a question here from Sophie. Do I need to file any other forms other than 5500 EZ for my solo 401k?
Do you need to file any other forms for your solo 401k other than 5500 EZ? Well, it depends. So if your total plan assets are over $250,000, then you are required to file Form 5500 AZ annually. Now, we actually recommend filing this form even if your total plan assets below that threshold for two reasons. Number one, you get the records established with the IRS. Number two, you start statute of limitation on that year. So again, good reason. And another reason that comes out of that is you actually get into a habit of doing that. You let's say you're under 250 now. Well, you do it for this year. You're not required to do it, but you do it. So you kind of, that's going to be your practice. So then when in the next couple of years you're required to file this, you already done it a couple of times, or you know how to do it. It's going to be easy for you because the first time is the most difficult. Again, it's not a difficult form, but it's going to be more work comparing to the next year and the next year, because the other years they will be almost on autopilot. You still have to do it, but it's going to be much easier to do. So that's on the Form 5500. In addition to that, if you had a taxable event in your 401k, let's say you took a distribution or you did a Roth conversion, then you have to report that those are reportable events. You have to report those using a Form 1099-R, and your plan issues that form. If you are a client of Sense Financial, we can help you with that. It's included in our services. However, we do need to receive the request from you, typically by January 10th. So be sure that you be on top of this and contact us at the end of December or begin first week of January and submit that request. Because if you're late, again, we got a lot of clients and we get inundated with these forms. We do need the time to process them. That's why we do have this deadline. So if you miss that deadline, you're going to have to do it on your own, which again, you can still do it. But we can help you with this as long as you submit it on time. So that's another form that may be required. And then if you made contributions to your 401k, all those needs to be reported as well. And there are a couple of ways to report them depending on your situation. If you are, let's say you're incorporated and you're making referrals, that will be reported, or that will be done through your payroll and will be reported to you on W-2 when you get that at the beginning of the year for the last year. And then it will be reported, you will give that to your CPA, it will be reported on your tax return, I believe on Form 1040. And then if you're making profit sharing contributions, those will be reported. If you're sole proprietor on a Schedule C, if you are incorporated, that will be reported on your corporate tax return, profit sharing contribution to retirement plan. So but for those, and we will work with your CPA.
Okay, a question from Drew. What are my options when I hire someone? Will I have to go to regular 401k plan where I have to pick from a list of funds offered versus being self-directed?
That's a very good question. So just as a refresher, Solo 401k designed for those people who are either self-employed or own a business and have no employees. I might have missed that second point earlier when I was talking about this. You cannot have any full-time employees working for you. And the rule for part-time employees also changed. It's under 1,000 hours that your employees work for you, as long as they're not long-term part-time employees. And long-term is somebody who worked for you for more than 2 years. then that threshold is lowered to 500 hours. So you better remember this 500 hours threshold. So if you have employees working for you more than 500 hours, then most likely you're no longer eligible for solo 401k. So it's not funds versus self-directed. It's just you are no longer eligible for solo 401k, and you will be required to terminate the plan. You can switch to like a full-blown 401k that can accommodate the employees. But you will need to make the change. So be sure to contact our office. We can help you determine whether you're no longer eligible or can continue, or what the options are. And then you will need to make some changes.
Okay, a question here from Bobby. We have a solo 401k with an S Corp. So for 2024, to clarify, $30,500. I'm 71 on the employee side and 25% of wages on the employer profit sharing side. I mistakenly did not raise my wages and just left my wages at 93K, but made 200K. So should I have raised my wages so I can have more of a profit sharing tax shelter? Is there anything I could do now to get more of a tax shelter on the profit sharing side?
Well, if you're talking about year 2024 and you already paid yourself wages, you already received the W-2, I don't believe you can change that. W-2 is done. You cannot go back and undo your payroll. That's done. I doubt you can check with your payroll provider, but I highly doubt that is possible. So I don't think you can do anything for 2024. So you certainly can do it for this year, 2025, but I don't believe you can go back and make any changes for 2024.
Another question from Bobby. Please talk about how to set up a self-directed IRA. I gather that I can have an IRA in addition to my solo 401k. So I'd have employee 30,500 plus profit sharing and the self-directed IRA.
Oh, you certainly can have both. You can have a solo 401k, and you also can have a self-directed IRA. Now, it really depends on your situation, because you don't want to overcomplicate your situation. And I always when I'm doing something, or when I'm consulting my clients or anybody else, I always try to remember the KISS principle, right? I don't know if you're familiar with that, but keep it simple, Sam. Actually, keep it simple, stupid. That's the originally, but the bottom line is you got to keep it simple. Okay. So what's the reason you're doing a self-directed IRA? If you talking about Roth IRA, then yeah, if you have existing Roth IRA, you can't move that to a solo 401k. You got to have a self-directed IRA. But if you have some pre-tax money, you can move that to self-directed solo 401k. Now, if you wish to contribute to an IRA, if you're eligible to make a tax-deductible contribution, which I doubt, based on your previous question and your income there, but talk to your CPA. If you're eligible to make a contribution to a traditional IRA, just open one up somewhere else. Open one at Vanguard or Fidelity or Wells Fargo. Make a contribution, and then immediately you can actually move this money to a solo 401k via direct rollover. So this way you don't need to have self-directed IRA. You can have everything under one roof. And that's, again, applying the KISS principle. Why would you want to complicate your situation by managing self-directed solo 401k and then having self-directed traditional IRA on top of that, where you can actually combine them? Yeah, there is an extra step by moving the funds, but that's much easier than maintaining two different self-directed plans, in my opinion.
Okay, a question from Neil. Can cryptocurrency in-kind distributions be made out of a solo 401k?
I believe so. Pretty much any distribution can be made in kind. So any asset. So if you do have an asset and you want to take a distribution of that asset, you don't have to sell it and take the cash out. You can potentially distribute the assets. So if it is a cryptocurrency, I'm not an expert in cryptocurrency, but I believe there is a value. You can assess what the value is on the day that you take the distribution. So it's the same thing as taking the stocks out. If you own some stocks in your solo 401k, well, if you want to take a distribution today, that stock has certain value today. So you need to document that, and then you will have to move it from your solo 401k brokerage account to your personal brokerage account. That will be considered in-kind distribution. And you can do the same thing with the cryptocurrency. So you just have to move it from your 401k wallet to your personal wallet. But yeah, if you should be able to do it. The key here is getting and recording that value of that asset that you're taking out.
All right, looks like we answered all of our questions today. We will wrap up our session here. Just wanted to thank everyone for joining and asking the questions. If there are additional questions, please reach out to us. We'd be happy to schedule a call with one of our experts to talk about your specific situations. We do look forward to you joining any future events that we have. But again, thank you for joining. Hope you all have a wonderful day.
Natalie, thanks for hosting, and thank you everyone for joining. Have a great rest of the day.